Welcome to our weekly Q&A. I'm Joey. With 24 companies to be listed, September is one of the busiest months for the Hong Kong IPO market. Our analyst Evan Yan will give us some insights into the Hong Kong IPO market today. Evan, how's the IPO doing in Hong Kong?
Despite the pandemic in Hong Kong, the IPO market has been extremely good in 2020. A total of 59 new companies got listed in Hong Kong in the first half of this year, with the money raised amounting to 87.1 billion Hong Kong dollars. This is an increase of 25% compared to 2019. The biggest two listings are both companies coming back from the US, JD.com and NetEase, where they have been listed as ADRs. Healthcare, biotech, and TMT names are the majority. Moving into the second half of 2020, more consumer companies appear on the list of new IPOs as a result of the good sentiments in the first few months. These include Yum China, the operator of KFC and Pizza Hut in China, and Nongfu Spring, the market leader of bottled drinking water in China. In Hong Kong, when companies are issuing new shares, retail investors will normally be guaranteed a certain percentage as one way of promoting the financial market and to benefit the local resident by the government. The percentage range from 15% to up to 40%, depending on how many times an issue is oversubscribed. It is noteworthy that Nongfu Spring was oversubscribed 1,147 times, being one of the highest oversubscriptions in the history of Hong Kong IPOs.
What are the reasons of such popularity for the IPO market in Hong Kong?
There are two major reasons of this. Firstly, Hong Kong is continuously optimizing its listing rules in order to encourage more IPOs locally. One major adjustment was the acceptance of stocks with weighted voting rights and secondary listing stocks into the Hang Seng Index, and the acceleration of the whole IPO process. These rule modifications boosted the willingness for many companies to list in Hong Kong, which want to do an IPO but were unsure about which market to choose for their listing. Secondly, American-listed Chinese companies, or what we call ADRs, are feeling the need to find a plan B for themselves. At a time of escalating tensions between the US and China over trade, over technology, and over recently financing investment, it is natural for Chinese companies listed in the US market to look for alternatives. In addition, it could also be beneficial for these ADRs if they list in Hong Kong in order to provide easier access for the mainland Chinese investors once their stocks are included in Southbound Connect, and this might further boost their valuations.
That's it for today. Subscribe to our channel and get updated on the latest happenings in China. Thank you and see you again soon.